Hello and welcome to the Hammond Iles Wealth Advisors Financial Power Hour. Today we're talking about the 2024 tax strategies, tax law changes that are coming into effect this year and in coming years, and the tools and strategies that you may want to implement in your own picture to make sure that you manage your tax liability. There is a common saying that the only things certain in life are death and taxes. And so today, we're going to talk about that second one, the tax thing. Although many times people feel like it's hard to get away from taxes, the truth is that there are many strategies that you can implement to eliminate or avoid taxes. And I'm not talking about anything shady here. It's a tax law that's built into the code to encourage you to follow some different strategies that Congress has put in place. So it is possible to give money from your taxable IRA to charity and not have it reported as income. It's also possible to build a retirement investment portfolio that can provide you tax-free income throughout your retirement. And we'll talk about that and some strategies around those today. So let's start off by first sharing the disclosures. We in our industry have to follow rules with the financial regulations, but also I want to point out specifically for today, since we're talking about tax strategies, that Hammond Iles Wealth Advisors does not provide tax or legal advice. And what I share with you today does not in any way replace what real life advice from your tax consultant or tax preparer can provide you specific to your situation. As I mentioned earlier, you are welcome to provide questions. I encourage you to type those into the chat. We'll make sure that we answer those questions as best we can during our webinar today. If for some reason we don't answer your questions, or if you're watching the recording of this webinar on YouTube, please email your questions to hello@hiwealth.com. So let's start off by just providing a little bit of tax history for you. When we look back at income tax, where did it really all start? Well, the first income tax was actually proposed back in 1814 to help fund the War of 1812. But by the time that legislation was making its way through Congress, the war had been ended, and so it never got implemented. The actual first income tax that was implemented was under President Lincoln, and when he signed the Tax Act of 1862. The law set a 3% tax rate for incomes above $600 and a 5% income on those above $10,000. Now, records show that very few Americans actually filed taxes back then, but with that Tax Act of 1864 following up on that to fund the Civil War at that time, taxes became experienced by many Americans. So following the Civil War, the idea of income taxes kind of faded, and there was many efforts to not allow them to be a permanent thing beyond funding the Civil War and Restoration. So it wasn't until the 16th Amendment to the Constitution in 1913 that gives Congress the authority to tax individuals on a national basis. And over time, that rate has gone up and down and certainly peaked out during World War II. But the White House and the Budget Office now estimates that individual income taxes this year will be equal to about 8.8% of the gross domestic product in the United States, and that will rise to about 10% by 2028. And if you're curious, last year on a calendar year basis, the U.S. government collected $2.12 trillion with a T dollars in income taxes, and that only funds about half of the U.S. budget. So in taking a look back at tax brackets, the first rate of 7% after the passing of the amendment to the Constitution was back in 1915. And you can see that during World War II, the rates got as high, and again, this is the top tax bracket, not for everybody, reached 94%. After that, in the 80s, it was around half of that. And in most recent decades, we've been around 40%, around 3.6%. That was reduced in the 2017 Tax Cuts and Jobs Act that reduced the current tax rates down to the current cap of 37%. But they built in a sunset provision. So we'll talk a little bit about that and how rates could go back up in 2026. So progressive tax in the US just means that as you earn more, the tax rate goes higher. And just a few did you knows about taxes is Americans who earn more than $200,000 per year, roughly 5.8% of tax returns, paid over 65% of all federal income taxes. And Americans who earn below $30,000 per year, or roughly a little over a third, 36.7% of tax returns, paid less than 1% of all federal taxes. And for those that find themselves earning between $2 million and $5 million, paid around 8% of all federal income taxes. So just some interesting facts to get us started. But let's dive into kind of what we're really here to cover. So in our presentation today, we're going to talk about recapping some of the key tax rules that you need to be aware of and understand. I'm going to touch on and highlight what I feel is the most underutilized savings account for retirement, the health savings account. We're also going to talk about why everyone needs a Roth IRA. If you don't know, I'm a huge cheerleader for Roth IRAs, and we'll talk a little bit more about that later on. And we'll talk about strategic gifting, both to family members as well as the causes and organizations we care about. It's important that we do that even in a tax-efficient manner. And then lastly, we're going to wrap up by talking about, does it make sense to pay taxes now or pay later? I'm going to take a look at a couple and some examples on ways of paying taxes now may be to your benefit. And we'll talk about how that can help you out over the long run, or potentially even for your beneficiaries. So let's take a look at key tax rules of some of the changes that are happening. A lot of the standard items have been indexed for inflation. So the standard deduction for 2024 will go up to $29,200 for those that are filing jointly. And if you're a head of household, just a little bit lower than that, $21,900. And if you're filing single, your standard deduction for this year will be $14,600. Now, it used to be that in addition to the standard deduction, we used to have a personal exemption, but that was eliminated in the Tax Act in 2017. Also in 2017, they put into effect a cap on the what are called the SALT deductions, state and local taxes. And that also includes your mortgage interest in that cap. That is still at $10,000. So if you are able to itemize deductions, you have a $10,000 cap, even though you may pay more than that in property taxes. One of the things that we're seeing more of is very few people are actually itemizing tax deductions at this point, because that standard deduction was increased substantially in 2017. Also, the ability to take a child tax credit is still at $2,000 per dependent if your modified gross income is less than $400,000. Mortgage interest deductibility, again, is subject to that cap under the SALT, but also it's capped in that it only applies to mortgages up to $750,000. which as property taxes over the last couple of years, I'm sorry, not property taxes, but property values over the last few years have gone up. That is influencing more and more taxpayers. And if you have a lot of tax exempt interest, you may need to look at the alternative minimum tax, but the level of income that the exemption avoids, that AMT, is now over $133,000 for those that are filing jointly. Now, also, one of the things that I want to highlight that many people don't pay that much attention to, we take a lot of time to look at our common income tax rates, but we don't look at capital gains tax rates. And what is a capital gain? Well, if you buy an investment at $10,000 and it grows to $15,000 and you sell that investment after holding it for at least 1 year, you pay capital gains tax on that appreciation. So in my example, that $5,000, based on your income, whether you're filing single or married, you would pay a capital gains tax on that. Most people don't realize that actually is a level of capital gains tax that is zero, that if you are married filing jointly and your taxable income is less than $94,000, you could actually recognize gains with no capital gains tax. The same for individuals that have less than $47,000. And unless you're earning well over $500,000, either individually or jointly, you're going to be in that 15% tax bracket for capital gains tax. So although you may be in a 22% tax bracket for your individual income tax on an income basis, capital gains tax would be lower. Please keep in mind that these tax rates are just on the federal basis. So if you're in a state that has a state income tax as well, you'll have that on top of the federal capital gains tax rates. So here are some of the changes that were put into effect with the Secure Act 2.0 and are just coming into effect starting in 2024. One of the things that is interesting is that now individuals that have 529 plans, it used to be there was a concern that if you saved too much, although I have yet to find a couple that saves too much for their college education for their children or grandchildren. But in the event that your child or grandchild goes to a school that's less expensive, has a scholarship, or some way does not use all of the 529 plan education savings that you've accumulated, there is the opportunity to roll those over into a Roth IRA for that child. It is limited to the same contribution limit. So if you have over $7,000 remaining, you'd have to do it over multiple years. However, there are also some other eligibility requirements, but it is a new opportunity to look at those old 529 plans. If you have any money still sitting in those, that may be eligible to roll into a Roth IRA. Also, while we're talking about Roths, many employer retirement plans, whether that's through a for-profit employer that has a 401k or a nonprofit that uses a 403b, those contributions that went to the Roth side of things, where you're contributing on an after-tax basis, it used to be that if you reached your required minimum distribution age, that in your employer retirement plan, you'd have to take a minimum distribution from the Roth side of the plan, as well as any money on the before tax side. However, that has been eliminated. So now the Roth side of a 401k or a 403b is treated the exact same way as a Roth IRA. There are no longer any minimum distributions required once you reach age 73 or potentially in the future at age 75. Also, one of the interesting things that was included in the Secure Act is the fact that with a large amount of students having student debt, one of the ways that companies can incentivize their employees to pay down that debt and still save for retirement is that companies can actually match student loan payments as retirement plan contributions. So if I were a student that had debt and I was paying down that debt, my employer could potentially match what I'm paying down my student loan as a retirement contribution. So that students that have debt aren't compounding their financial challenges by not saving for retirement because they're focused on paying down debt. So it provides companies an opportunity to create this added benefit for younger employers, or employees, I should say. And then the last thing that was added that takes effect this year is now there is an emergency withdrawal provision from retirement accounts. So now you can tap into a retirement account to take out a quick $1,000, and that's the ceiling or cap on that you can tap into for an emergency if you had something that you don't have the ability to tap into other investments or savings. It is still taxed as ordinary income when it comes out, just like any other retirement account distribution, but it does avoid the early withdrawal penalty if you're under the age of 59 and a half. So those are 4 of the Secure Act 2.0 new things that come into existence this year. And there are a couple of things that come into effect next year in 2025. One of the added things that they're adding to encourage individuals to save for retirement or make up for lost ground is that they're increasing catch-up contributions. At the present time, if you're making a contribution to an employer retirement plan or an IRA or a Roth IRA and you're over the age of 50, you're able to add additional money to that contribution as a catch-up contribution. Starting next year, for those between the ages of 60 and 63, you'll get an extra boost, and that instead of the $7,500 that you're able to contribute to your employer retirement plan now, you'll actually be able to bump that up to $10,000 during that 3-year window, or actually 4-year window, between 60 and 63. Also, employers must enroll all employees into their employer retirement plan. If you haven't read the book Nudge, I highly recommend it. It's a book that talks about different ways that you can create systems to nudge people to do what's in their best interest. And one of those is what is incorporated in the Secure Act 2.0. So rather than having an employee have to opt into the employer retirement plan, starting next year, it will be reversed. Employers will be required to enroll employees automatically. And then if employees don't want to add to the retirement plan, they have to opt out. So the default action is that you're automatically going to go in. If you don't want to save for your retirement, you can opt out, but employers are automatically going to enroll employees starting next year with at least a 3% contribution going into the plan, but no more than 10%. And it actually builds in an automatic increase up to that 10% over time. So it definitely is a step in the right direction to encourage employees to save for their retirement. Now, one of the things I mentioned earlier when we were talking about the 2017 Tax Cuts and Jobs Act is that there is a sunset provision. So it took effect as of January 1st, 2018, and it has a sunset provision that ends at the end of 2025. So effective January 1st of 2026, if Congress does nothing at this point, all of those tax changes, not all of them, but you'll see most of them, will revert back to the way that they were in 2017. A couple that I want to highlight is that the individual tax rates will go back, and on my next slide, I will share what those look like. That larger standard deduction that we're just talking about reverts back to the lower standard deduction. The personal exemption comes back into play if allowed to sunset. That cap on the SALT taxes goes away. The doubled child tax credit goes away, and the doubled estate tax exemption goes away. Currently in 2024, the estate tax exemption per individual is currently at $13.61 million. So as a married couple, you're able to give over $27 million to family without any estate tax. That was doubled back in 2017. So if that tax law is allowed to sunset, the estate tax exemption will get cut in half. So if you are over that $7 million range in your net worth, this might be something to take a look at with your estate tax planning to make sure that you can take full advantage of the exemption that may go away after 2025. And you can do that by making gifts and some different estate planning strategies now before it sunsets to take advantage of the current $13.61 million exemption before it gets reduced. In my opinion, I don't think even if it does go back in half, it won't go any lower than that. And that's just largely because many Congress people have net worths in that range or in that ballpark. And the last thing they want to do is cost themselves estate taxes. So they have a little bit of a conflict of interest there that they will prevent them from most likely reducing it any lower. So what do the tax rates look like? Well, here in the first column on the left-hand side, you'll see what the tax rates are for 2024, ranging anywhere from 10% up to 37%. And we have the tax brackets for this year, so you can kind of see where you may fall relative to the tax brackets. And then to the right of that, if the 2017 tax law is allowed to sunset, what the tax rates will go to. The biggest thing that jumps out at me is really for those that are in the lower tax bracket of that 12% current bracket. That's going to go back up to 15%. That 3% increase on 12% is a 25% increase in taxes. So that is a substantial increase for those in that lower tax bracket. But you can see that everybody across the board will see some tax increase if that's allowed to sunset. So we'll have to see what the outcome of the election is this November and what the makeup of Congress is on what may or may not happen before December 31st of 2025. And if Congress acts in the way that they have many times, it probably won't be decided until December of 2025. So we'll wait and see, but it may come into play on your planning for taxes for both this year and next year, whether you may want to take advantage of lower tax rates that may go up following 2025. So the first way to start our kind of tax strategies conversation is to look at investment-related taxes related to tax advantage tools. And one of the best ways to avoid tax on tax appreciation and dividends and growth is to save in a retirement account. For those that are employed and have earnings, you're able to contribute to either an employer account like a 401k, 403b, or a 457 plan for municipalities, or a thrift savings plan if you're a federal employee. The contribution limit is $23,000 this year. And if you're over the age of 50, you get that $7,500 catch-up contribution. So if you're over 50, you could add $30,500 to your retirement plan this year. For traditional IRAs as well as Roth IRAs, that limit is $7,000 this year. And again, if you're over the age of 50, you get a $1,000 catch-up contribution on top of that. One of the things that I wanted to point out also related to the tax deductibility or the ability to give to those plans on a tax deductible basis, especially when it comes to a traditional IRA or Roth IRA, there are eligibility requirements. For a traditional IRA, it applies, you need to look at your income, your filing status, and whether you have an employer retirement plan. There is a lower phase-out range if you have the ability to contribute to a 401k or other employer retirement plan. Whereas a Roth IRA, and this is, again, one of the reasons why I love Roth IRAs, is whether you have a 401k or an employer retirement plan, it doesn't matter. Anyone who doesn't exceed the income phase-out levels is eligible to contribute to a Roth IRA just by the fact of having earned income. One of the other things that I want to mention as a side note here is that it doesn't have to be your earned income. So if you are a stay-at-home dad and your wife is working, she or he, as your partner, can have earned income, and that can cover your eligibility to have earned income to make a contribution. So as long as you have a spouse or partner that has earned income, that can cover you if you're not working currently or have earned income of your own. As long as the amount that they're earning is more than the amount that you're contributing to your retirement accounts, then you're all set. But again, I recommend consulting your tax accountant or preparer and your eligibility to contribute. And with these traditional and Roth IRAs, you have up until the due date of your tax return, which is April 15th, to make that contribution. So you have up until April 15th of 2024 to contribute for 2023, and you'll have up until April 15th of 2025 to make your contribution for 2024. So the second thing on our agenda is what I'm calling the underutilized health savings account. Many people don't think of a health savings account as a vehicle or an account to save for retirement, but I'm going to walk through kind of some of the basics around health savings accounts to give you some insight on how this can be a great tool in saving for retirements. So just to give you some background, a health savings account is a tax-advantaged account to help you save for medical expenses that are not covered by a high deductible health insurance plan. So basically your contributions, if it's offered through your employer, can go right out of your paycheck before taxes, or if it's not offered through your employer, or if you give more than what you're having deducted from your paycheck, it's tax deductible on your tax return. Now, once those contributions are in your HSA, the earnings grow tax deferred, and all the distributions that come out that are used for qualified medical expenses come out tax-free. So this is what we refer to as kind of the triple tax benefit. So the money going in, you get a tax deduction, or it goes in before taxes. It grows tax deferred and comes out tax-free. So it's a win-win-win situation in saving money for medical expenses. Now, again, your contributions can be made by you or your employer, but whether it's from you or your employer, there is a ceiling or a cap on what you can contribute. And unlike a flexible savings account or a medical savings account, any unused funds in the fund in a health savings account carry over to future years. So there's no requirement that you have to spend it, use it in this year if you're making a contribution. You can continue to put away money into a retirement account, get the tax deduction today, and then use the money in the future for medical expenses. This is a great way to save for medical expenses in retirement. So if you're eligible, this is a great vehicle for saving for retirement. So to be eligible to have a health savings account, there's 4 things that you need to have. One is that you have to have a high deductible health plan. And I'll go over some of the qualifications on the next slide. You have to have no other health coverage. So you can't be covered by your spouse's plan, for example, or some other coverage. And I'm sorry, if you're over age 65 and you're on Medicare, you're not eligible for a health savings account. You've crossed over that line. And so at 65, your ability to contribute to a health savings account goes away. But that doesn't mean that the money that you put in before age 65 goes away. You can continue using it for the rest of your life. Also, you cannot be claimed as a dependent on someone else's tax return. So if you meet those 4 qualifications, you're eligible for a health savings account. And what that looks like is that you have a maximum contribution in 2024 of $4,150 for individuals and $8,300 for a family. Individuals over the age of 55 can also have a catch-up contribution. Congress loves catch-up contributions, and so they added one to the health savings account as well. So you can add an additional $1,000 if you're over age 55. Now, again, that contribution limit is subject to both what the employer puts in, if you have the benefit that you have an employer that's contributing to the plan on your behalf, as well as what you put in individually. And just like a traditional or a Roth IRA, contributions can be made up until the due date of your tax return. So for individuals that have a health savings account, you can contribute for 2023 up until April 15th of 2024. Now, to qualify as having a high deductible health saving or health plan, you have to have a minimum level of a deductible. And for individuals, that's $1,600. And for a family plan, that's $3,200. Now, one of the nice things about health savings accounts is that you control how that is invested. Now, if you have a plan through your employer, most likely they will have a company that they are setting up the accounts with. However, if you're at an employer that doesn't offer a health savings account, but yet you still have that high deductible saving or health plan, you can create a health savings account on your own. And it's just a type of an account, so you don't have to go anywhere specific to set it up. You could set up a health savings account at your local bank if you wanted to put it in CDs or savings. You could open it up at an investment company or even through an investment advisor. So you have the opportunity to create health savings accounts where you choose. And if you're saving for retirement, so you're 5, 10, 20 years away from needing that account in ages 65 and older potentially, you could invest that in a diversified portfolio and grow it over that time frame while it's waiting. Now, distributions that come out for non-medical expenses are taxed as income. So another way to think about a health savings account is it's just another way of saving for retirement, like an individual retirement account or an IRA. It comes out as taxable income if you use it for things other than medical expenses. And it does have an early withdrawal penalty. It has a 20% tax penalty if you take it out for non-medical expenses before age 65. You can take it out for medical expenses at any time, at any age, without any penalty or income tax. But if you wanted to save in that account and you didn't have the medical expenses in retirement or along the way, you can always take money out and use it for retirement expenses. You would just pay income tax on it. And those funds that go for qualified medical expenses include your deductible that you have for your health insurance, your dental, your vision, prescriptions, co-pays, and psychiatric treatments. So there is a wide array of health-related expenses that qualify for a health savings account. So you'll want to take a look at that to make sure that you use it for everything it can. So it's a great way to save for retirement. If you're eligible, I highly recommend, if you're able to, max out your contribution, save and invest it, and grow it for your retirement. Even if you don't need it for qualified medical expenses, it's a great way for it to grow on a tax-deferred basis, just like a retirement account. So number 3, this is my favorite. Why everyone should have a Roth IRA. So some of the Roth IRA basics is that after tax, non-deductible contributions go in to the account. So you're already paying the tax on it now, and that's up to $7,000 for those under age 50 and $8,000 with that $1,000 catch-up contribution for those over age 50. And the contributions must be from earned income. So that comes from a W-2 or a 1099. So I'm sorry if you're receiving a pension or Social Security, it doesn't count. If you have a part-time job or you're doing consulting in retirement and you have earned income, you are eligible. And again, earned income from a spouse or partner qualifies as earned income. For 2024, the eligibility phases out for individuals between $146,000 and $160,000, and for married couples between $230,000 and $240,000. So if your income is over that level, I'm sorry, you can't contribute to a Roth IRA, but you can contribute to the health savings account because there is no income limitation on a health savings account. The account grows tax deferred until the funds are distributed out of the account. And when they come out, as long as you've had the funds in there for at least 5 years and after age 59 and a half, all of that growth comes out tax-free. So it's a great way to grow money tax-free. And because it comes out tax-free, there are no required minimum distributions. So some of the reasons why everyone who is eligible should have a Roth IRA is that the contributions going in can be distributed tax-free without a penalty at any age, at any time. So if I put in a contribution of $7,000 this year and I have an emergency that I can't find the money for 2 years from now, even though I'm under the age of 59 and a half, I can pull that $7,000 back out of my Roth IRA and use it for whatever I need it for, and it comes out tax-free without a penalty. Now, the growth on that $7,000 has to stay in the Roth IRA until age 59 and a half and at least 5 years for it to come out tax-free, but the contributions can come out at any time. Also, conversions, investment earnings growth can be distributed tax-free without penalty, as I said, after age 59 and after the 5-year time frame. And this provides a wonderful way to diversify your income in retirement from a taxable part if you have retirement savings and from a non-taxable Roth IRA. You also have the ability, if you have money in a traditional IRA, you have the ability to convert it to a Roth IRA, and we'll talk a little bit more about that. And you can also contribute to a Roth IRA at any age. So even after age 73, where required minimum distributions kick in for employer retirement accounts or for IRA accounts, you can still contribute to a Roth IRA, again, as long as you have earned income and you're eligible to contribute. So you're within those income ranges. So if you're doing, again, some part-time work, sock it away in the Roth IRA. You can always pull that money back out, but let it grow tax-deferred and have those earnings come out tax-free to you or your beneficiaries down the road. So number 4 on our agenda is strategic gifting. On how do we give to the people, causes, and organizations that we care about in a very tax-efficient manner. One of the things that is available to all of us if we want to be very generous to our family members today. And that may be part of your estate plan, is to start gifting now. Or you may want to start gifting because you want to see your children, grandchildren benefit from your gifts while you're living, rather than waiting for them to inherit it. For 2024, the personal exemption amount is $18,000 per person per year. Now, as an example, if I have 3 children, I can give each of my children $18,000. And my wife can also give each of the children $18,000. So altogether, each child could receive $36,000. And because it's within this exemption amount, there is no tax reporting for both myself as the gifter or my child as receiving that gift. There's no tax consequences. And this can be in the form of cash, or you can actually gift investments. So if you have children or grandchildren that are in lower tax brackets, you may want to give them appreciated investments. It doesn't have to be cash. But if you stay within that $18,000 exemption amount, there's no tax reporting on an annual basis. Now, when we're talking about gifting, I like to talk about Sue and Matt and just quickly go through an example. One of the things that many charitable individuals are finding is that because the standard deductions are higher now, their charitable giving isn't at a level that they're able to itemize their taxes. So in this case, for Sue and Matt, where they're giving $15,000 per year, their standard deduction is $29,200 for 2024. So if they're just giving that amount, they get no tax benefit for that charitable giving. Certainly, if they have other deductions, they could potentially get up, but even with that $10,000 cap on property taxes, it still keeps them from hitting that above the standard deduction amount. So one of the ways that they can do some tax planning and take advantage of the charitable giving is what we call bunching, where you basically take deductions from multiple years and bunch them into a single year so that you can deduct them and itemize in one year. And then in the following years, you use the standard deduction and get the higher amount, even though you're not making the charitable contribution. So in Sue and Matt's case, again, they're contributing $15,000 a year. So what we did is we created a donor advised fund. In this case, we call it Sue and Matt's Amazing Impact Fund. And they took 3 years worth of charitable donations. And so they put $45,000 into the donor advised fund. So then that can come from either a bonus perhaps that you might get, or appreciated investments, or if you have a spike in income, you can carve that out and put that into a donor advised fund. Now, what happens then is when they want to give to charity, they just send in a grant request to the donor advised fund, and the donor advised fund pays it out to the nonprofit. So here are some of the benefits of following this bunching by using a donor advised fund. One is it allows them to claim a larger charitable deduction in a single year. So in this example, they're able to deduct the full $45,000 as a charitable deduction. Rather than the 15 per year, they're able to exceed that standard deduction and be able to itemize. Then in years 2 and 3, when they're giving the additional money out of the donor advised fund, so they're not giving any more to charity or the donor advised fund itself directly, they're still able to use the standard deduction in those years. The other nice thing is no matter how many nonprofits you donate to from the donor advised fund, for tax purposes, you only get one tax record that you have to worry about. So when that money goes into the donor advised fund, you get one tax record saying, hey, you donated the $45,000 into the donor advised fund. here is your letter for your taxes. Also, if you're donating appreciated investments, it allows you to avoid capital gains tax. So in this example of donating 45,000, if they were donating a mutual fund or exchange traded funds or stocks that they inherited or have held for a long time, it may have a large capital gain built into it, but by going into the donor advised fund, the donor advised fund sells it, not them. So there's no capital gains tax. Also, those funds inside the donor advised fund, they have complete control on it. So they control the amount on how it's invested over the time frame. The balance can stay in the donor advised fund. There's no requirement that it has to be paid out. I have one client that sold a business. And so at the time that they sold the business, we took some of that to fund the donor advised fund and get a larger tax deduction to help offset the sale of their business. And that balance can stay in the donor advised fund as long as they want, and they can pay it out as they choose. There's no requirement to pay funds out on any annual basis. And as I mentioned earlier, it can be paid out to multiple organizations and causes. Now, one of the other things in taking a look at tax advantage gifts is that most people, when you get asked for a donation, you'll think of that you have to take out your credit card or you have to write a check or pull cash out of your wallet to make that donation. But I want you to think differently. Instead, think about non-cash gift strategies where you can give once and save 2 or 3 times by doing it. So I mentioned as part of the donor advised fund that one of the options you could potentially gift stock. And here is an example of that, whether you give it to a donor advised fund or directly to a charity. If you purchase a stock back in 2015 at $20,000, and as of March 30th of this year, it's now worth $45,000, you have an unrealized capital gain of $25,000. So just those capital gain tax rates that we looked at, but depending on your income level, could potentially be 15% or 20% at the federal level plus state taxes. So if you were to sell this stock and then write a check for $45,000 to charity, you would pay capital gains tax on that $25,000. However, if you take that same stock and you just donate it or transfer it to the nonprofit or a donor advised fund or another nonprofit entity, your tax deduction is equal to the market value as long as you've owned it for at least 1 year. So you would get the tax deduction of $45,000. And you'd have the additional tax savings that there's no capital gains tax. And if it goes into a charitable fund like a donor advised fund, it allows you to diversify away from that stock and potentially have a more broadly diversified portfolio going forward. Now, one of the other things that I want to make you aware of when we're talking about giving to charity is if you're over the age of 70 and a half, you have an opportunity to do what's called a qualified charitable distribution. I mentioned at the top of our webinar that you can potentially give money from your taxable IRA without any income taxes. And this is a strategy to do that. For individuals over the age of 70 and a half, you can distribute up to $1,500 per year from your IRA directly to 501c3 charity. And that will index for inflation each year. So it used to be 100,000 last year. It's 105,000 this year. The QCD paid out of the IRA is not reported as taxable income. However, you don't get the tax deduction as a charitable donation, but it does count towards your minimum distribution. So if you're over the age of 73, you get a double win. You get the charitable benefit. It's not taxable, and you get to count it towards your required minimum distribution. Also, there is a special provision that you can make a one-time lifetime donation from an IRA to what's called a split interest entity. And some examples of those are a charitable remainder trust or a charitable gift annuity. If that's of interest to you, I encourage you to reach out to our office at hello@hiwealth.com, and we can talk about those in more detail. Those can be ways to create more income for you in retirement through a charitable gift straight from your IRA. And then starting in 2024, the annual limits, all of these amounts will be increasing for inflation. So that brings us up to number 5. Our last topic as we wrap up the hour, paying taxes now or paying later. So some of the challenges that I see on the horizon is our gross national debt right now exceeds $34 trillion. That is going to have to get paid in some form or fashion at some point in time. So the question is, how are we going to pay for it? Odds are somebody's going to have to pay more taxes at some point. Also, the Congressional Budget Office is projecting that Social Security is heading for insolvency in 2033. That's also going to need to be funded in some way. And as interest rates have gone up over the last year, the Congressional Budget Office estimates that interest payments on the national debt, now over $34 trillion, is going to balloon from $639 billion last year to over $1.6 trillion a year starting in 2034. So it's important that that debt gets paid down, or otherwise we're going to be paying a lot of money just on the interest to keep it in play. Also, one of the things to keep in mind is that Secure Act that was passed in 2019 eliminated the stretch IRA. So this is going to come into play when we start thinking about passing on retirement accounts to our beneficiaries, that for all non-spouse beneficiaries, there is now a 10-year rule where they will be required to withdraw all of the funds out of your IRA, Roth IRA, 401k, all of your retirement accounts within 10 years of you passing. And so you may want to take that into consideration as we start talking about whether to pay tax now or pay tax later. So here is some ideas on ways of paying tax now and saving money down the road. One of those is a Roth conversion. And conventional wisdom says, well, if I pay taxes now, well, taxes are lower. I can benefit if taxes are higher later. Now, of course, we don't know what future taxes will be, so it's all a guesswork, but it can be an opportunity to potentially lock in lower rates. There's also some other advantages that we talked about with Roth IRAs, but some of the other factors that can go into the decision process of whether to do a Roth IRA conversion is, do you have taxable Social Security? You may want to create a Roth IRA to help you reduce your taxable income that can reduce taxes on Social Security. And we'll go over an example of that in just a minute. Roth IRAs also provide the opportunity for income diversification. So you can choose year to year how much do you take from taxable or tax-free sources. Also, with market volatility, if we do have a market pullback or certainly expect the market to continue to grow, let me say that again, if we expect the markets to continue to grow, now could be an opportunity to lock in a lower account value and converting it now, or trying to time it, although I never recommend trying to time the market with anything. And then lastly, with legacy building, because there's no required minimum distributions for Roth IRAs, anything that you have in a Roth can stay there, grow, compound, and pass on to the next generation or your beneficiaries, especially if you don't need it for income purposes. Also, it just reduces that income tax liability for your beneficiaries. Again, with that 10-year rule, even with a Roth IRA, they'll be required to take it out within 10 years, but they can let it stay in for the full 10 years and take it out as a tax-free distribution in year 10. So here are Mike and Barbara. Mike and Barbara, they are both age 60, starting out in our first example. They're currently working and they have a household income of $100,000. Now, when they retire at age 66, which for them is their full retirement age, they plan on taking their $100,000 of income by $46,000 that they'll receive from Social Security and making up the difference in traditional IRA withdrawals. So how much of their Social Security benefits will be taxable if they take the withdrawals from their traditional IRAs versus Roth IRAs? And just as an example, we're taking a look at their Social Security, $46,000, traditional IRAs, $54,000. Because they have an income over $44,000 as a married couple, 85% of their Social Security becomes taxable. So out of the $54,000, they'll pay tax on $34,000. From that standpoint, they'll pay an additional tax on that in addition to the $54,000 that they're taking out of their traditional IRAs. Also, with a Roth IRA, because it's not taxable coming out, none of the Social Security becomes taxable. So the full $46,000 is not fully taxable. So some of the things then to look at going forward, and Joe, I appreciate you pointing out on being careful on conversions, and we'll talk a little bit about some of the things to be cautioned about on considering this tax strategy. But if we also look forward on not only the benefit to Mike and Barbara during their retirement by having less taxable income on their Social Security, they can also create a larger legacy to their son. And so let me quickly go through that, looking at if Mike converts $200,000 of his IRA to a Roth IRA, if he pays the income tax on that conversion out of the conversion, if we assume that he has total taxes of 25%, he would pay roughly $50,000 in income taxes. In an ideal situation, I would only recommend converting what you're able to pay tax on outside of the Roth IRA or outside the conversion. That way the maximum amount goes into the Roth IRA. But certainly you'll see that the benefits also can benefit if you assume that you pay the tax out of the conversion. So in this case, he's starting out his Roth IRA with $150,000. Now, if we're assuming that it's just a 6% annual growth rate, and that the requirement distributions are taking out on December 1st of each year, just for the ease of calculations. If we take a look at the two scenarios, if Mike started with the $200,000 in his traditional IRA and $150,000 in the Roth IRA, and he passes away 6 years later at age 78, over that time frame, he would have withdrawn around $39,000 in required minimum distributions after taxes. Nothing would have come out of the Roth IRA because he doesn't have minimum distributions on Roth IRAs. So at the end of that time frame at age 78, when he passes, the traditional IRA would have been worth around $220,000 and the Roth IRA around $213,000. So not quite equal, but certainly there is a difference because the $220,000 is pre-tax and will be fully taxable to his beneficiary or his wife when they take money out. But the Roth IRA is completely after-tax money, and we'll see how that kind of plays out. So Barbara inherits that. She lives for another 9 years and passes away at age 87. So again, with that 6% growth rate, the IRA grows after taking out $86,587 in minimum distributions to around $218,000. Whereas the Roth IRA, again, no minimum distributions required. So it grew to just shy of $360,000. So at that point, Barbara passes away and it goes on to their son, Mike Jr. So Mike Jr. inherits those accounts. Now, because he's a non-spouse beneficiary, he will be required to take that money out within 10 years. So on a traditional IRA, if he stretches that out over 10 years, assuming that he's in the same tax bracket of his parents, he will end up with around $216,000 after taxes. Whereas the Roth IRA, he can let that stay in for another 10 years and then take it all out in year 10, and it'll come out tax-free, and he'll walk away with $643,000 and change as his benefit from the Roth IRA. So you can see that in this example, paying the tax up front, paying tax now, no matter what happens with tax rates, can be beneficial to beneficiaries down the road, just by the nature of required minimum distributions and the compounding growth of money over time. So this may be a scenario to take a look at, and there are some things to pay attention to when converting. Now, converting part or all of an IRA, and again, you can carve off the amount that you want to convert, may bring up your income tax bracket. And as Joe mentioned in his comment in the chat, it can also influence your Medicare payments on your charge if you're in a higher bracket on the Medicare side as well. So you want to make sure that you consult your tax consultant on what amount may be advantageous to convert for you. By anything that's converted, if you're under the age of 59 and a half, converted assets don't incur the 10% early withdrawal penalty. However, if you use part of that conversion to pay the tax on the conversion, that would be subject to the early withdrawal penalty. So if you're under age 59 and a half, you just want to make sure that you can pay the tax outside of the conversion. Conversions must be completed by the end of a calendar year. So unlike contributions going in that you have until April 15th, conversions have to happen within the tax year. Also, if you are over the age of 73 and are required to take a minimum distribution, you will be required to take out your minimum distribution first before you can make a Roth IRA conversion. So something to be aware of. If you normally wait to take out your minimum distribution at the end of the year, you may be required to take that out earlier if you want to do a Roth IRA conversion. As I mentioned earlier, conversions are always most effective if you pay the income taxes outside of the account. And it's really important to understand all of the tax consequences before converting an IRA to a Roth IRA. So it's important to consult your tax advisor. So one of the other things in looking at planning for tax strategies for this year, take an inventory of all your potential sources of retirement income and review the tax treatment for each, and consider adjusting where you're drawing that income and your investments on where they're allocated between those sources. Don't forget required minimum distributions. Although the Secure Act did reduce the penalty on missing a required minimum distribution, no sense making a penalty if you don't need to. And make sure that you try to manage your tax situation on the income by efficiently taking income as well as your gifting that we outlined today. So how can Hammond Iles help? Well, we can offer a free conversation. Even if you're not a client of Hammond Iles Wealth Advisors, you can go to our website at hiwealth.com, click on a button for a free conversation with a financial coach. We'd be happy to answer your questions on anything financial. As a firm, our philosophy is that we all start from zero. And so we're out to help families across multiple generations. And so our youngest client is 10 years old. We have no minimum investment amount. So don't be concerned that you may not qualify to work with a financial coach, because we don't set account minimums. We offer online financial power hours like the one that you're watching now. If you're watching on YouTube, you'll find all of our workshops as well as our weekly Financial Friday 60-second messages on our YouTube channel. I encourage you to follow, connect, like us on social media so you get notifications of all of those workshops as well as our videos. And there are additional resources available for free on the Hammond Iles website. And that again is hiwealth.com. So at this point, I'm going to take a breath. If you have any questions, please add those in to the chat and we'll be happy to answer them for you. If you're not able to ask a question, please feel free to email them to hiwealth.com.